Tom Barkin, the Richmond Fed president. Tom, thanks for joining us around the table.
Thanks,
Takes
Steve.
a bit of courage for you to be here
That's right.
and face this rogues gallery here. But let me start off in an unusual place. Rather than hammering you about what you think about interest rates and that, which we'll get to, you started off many, many months ago with this idea about inflation. And the profound insight you brought was that inflation is not this abstract process. It's this idea somebody has to raise prices, somebody has to pay them. And you were very tuned into the corporate culture, given your business background, of companies having the ethos or the culture of raising prices compared to what it used to be. Where are we at now, in your opinion, in your discussions with business people? Is this culture of raising prices still in effect right now, such that it causes you concern about future inflation?
Good. So thanks for your nice words. You know, what I've been saying is that for 30 years before COVID, price setters had been beaten into submission, that you really didn't have the power to increase prices. And consumers had grown with the expectation that prices weren't going to go up. It's just very hard to do anything. So you have 2 years where all of a sudden people have the power to increase prices, and they have logic for it: wage costs, supply chain, revenge spending, whatever. And so given the opportunity, they do it. Now, I definitely think we're on the back end of that journey. I mean, when I talk to price setters, they know that inflation has come down, and they know that a lot of these extraordinary pricing power is no longer, in their hands. But I think they're still pushing, and it's a little bit of what we saw in the data yesterday. A fact that I think is useful: if you go back to the 10 years before COVID, 26% of the PCE basket had price increases greater than 3%. If you look at the last 12 months, where it's 2.4%, 55% are over 3%. And so you've still got a world where people are increasing at more than normal or more than historic levels. Luckily, it's been offset over the last 12 months by a bunch of places like used cars that are coming down. But it's not the spread. It's not the dispersion that we used to see. You still have more pricing power out there. And like I said, luckily, it's being offset by some amount of prices coming down.
In my mind, when I think about the story you tell, I think about a dam breaking. And now you're trying to, shovel mud back over with the flow of the water and put that dam back into place. One of the things people believe is required is slower consumer spending and slower growth. But you don't seem to be getting that. So does that make you pessimistic about the idea of bringing down inflation?
Well, the places where it's coming down the most nicely is in goods. And you do find that in a lot of these goods sectors, home improvement would be an example, you do see slower growth. And so I do think that slower growth has taken the edge off. I do think whatever combination of excess inventories or the big box retailers negotiating a little bit harder, has brought prices back down. And you may need that in the rest of the services part of the economy. Vacancies, for example, on the apartment side are rising slowly. You may need a little bit of vacancies to bring the edge off of that as well.
Let me go back now to where Joe started, which is, what was your view of that inflation data yesterday? Do you see it as an anomaly, or is it raised concern that we're on the leading edge of a reacceleration?
I mean, I try to discipline myself not to take too much out of January. That's the first thing.
January in general.
January data, I mean, you've got weather issues, you've got seasonality adjustments, which are extreme and even more extreme because we had a couple of Omicron waves, during COVID. So I've tried to discipline myself not to look at January too closely. And by the way, that was true of last January, too, where you remember we saw a blowout January. That said, it's consistent with the story that I'm hearing, which is on the goods side, inflation settling. On the services side, not so much. And of course, you're dealing with this balance issue, and let's see where we go over the next few months.
Do we need to rethink everything we've learned about the relationship of a strong economy and inflation? And is it possible that AI productivity could allow us to stay at full employment and not have inflation? I mean, that would be amazing, would it not?
Nobody's rooting against that, so that would be great. Productivity could well be part of the story, but as you know, we've had good productivity numbers the last couple quarters, but if you take a 4-year lens, and you have to do that, I think, because of the dislocations of the pandemic, what you'll see is productivity went up, productivity went down, productivity's gone up. The 4-year number is about where it was before COVID, a little bit higher. So if you think that AI is going to come and bring great productivity, that'd be awesome. One of the issues that I've been wrestling with in my mind is that to the extent that cost increases are driving inflation in sectors like construction, right? how much is AI going to help you in those sectors? Right? It's going to help you in a lot of sectors, professionals, but is it really going to help you across the
Has
economy?
anyone ever at the Fed said, we're at X, 3.5% employment, we need to get to 5 to cool off inflation? Has anyone ever said that's what we are going to aim to do?
I haven't heard anyone.
Is it
use that
implied?
phrase.
Do you think we need to do that?
No, I think we need to bring inflation down. And by the way, with spending normalizing, with labor availability increasing, with a lot of the supply side issues that we had during COVID coming down, inflation's coming down. And at 2.4%, we should be cheering that, not criticizing it.
But
on the other hand, we'll just see how much more has to happen to get
the perfect
inflation
world.
where
I
you
just
need
don't
to
know
go.
if it exists, if we could do it, right? You'd like that, wouldn't you?
I would.
And we've started saying maybe it's possible, right?
I would absolutely love it. It's an interesting. We're going to talk about that later, but
if you don't look at January and think much of it, if you see a similar sort of gain in inflationary numbers for the month of February, is that something that starts to concern you?
Yeah, oh, sure. One data point is one data point. All of a sudden, 2 data points, you can draw a line between them, and with 3, you can draw all kinds of geometric shapes. And so I think the more you see that, let's not forget that in the 7 months before January, we got very good inflation readings in total. And then in January, we had a not very good inflation reading. So we'll see where we are as the months go on. I think it's an important time because the overall numbers are likely to come down over the next few months because the comps from last year weren't very good. And so we're rounding over, we're losing those high inflation comps. And so we've got a shot here to bring inflation down, very close to our target. On the other hand, if the monthly numbers come in at a level inconsistent with where we're going, that'll tell us something different.
But you don't sound like you're in a rush to cut rates.
I'm never in a hurry to make any decision. We'll get to the meeting. We'll see what we learn.